Hi everyone, Shaun Humphries here. Welcome to All Things Retirement. In this video, I'm going to talk about 10 critical topic areas that you need to reflect on to get clear on 5 years out from retirement. Our team has spent the last 3 decades helping Canadian families get ready for retirement and to transition successfully into retirement. So we've learned a few things along the way, and we'll share some of those key ideas with you in this video today. Now, if you're new to our channel, make sure you hit the subscribe button. We're posting content all the time on various aspects of retirement income planning and overall wealth planning. So if you don't want to miss future content, hit subscribe. And if you like the video, make sure you hit like. Now, when it comes to looking at your retirement planning 5 years out from the retirement date, one of the first areas that you want to get clear on will be your government benefits. Old age security is an easy one. For most people, it's going to begin at age 65. It's a standard benefit rate. It's taxpayer funded. You don't make contributions to it. And then you've got Canada Pension Plan that you do make contributions to. So with Canada Pension Plan, if you've worked full-time for the majority of your working life, then probably you're going to be close to the maximum pension plan at age 65. And so that would be, for many people, about 85% of the CPP maximum, because most people haven't worked at full maximum pensionable earnings for their whole career. So that's a good starting point, 85% of the maximum. Now, ideally, what you want to do is go to the Service Canada or Government Canada website to begin the process of getting an estimate for your Canada Pension Plan benefits. So what you see here is just the Government of Canada website, and if you punch in CPP retirement pension, how much will you receive? You should be able to get to this particular site. So this particular page starts going over what the maximum benefit is at age 65. It takes a look at the average amount paid recently up until July 2022, and then you can get an estimate of your monthly Canada Pension Plan benefits by logging into your My Service Canada account. There's also a useful Canadian income retirement calculator, which is actually pretty good. So as a first step, I'd encourage you to, if you don't have it already, set up your My Service Canada account, make the application for an estimate. And I would encourage you to take a look at the Canadian Income Retirement Calculator as a way of getting some preliminary estimates on your potential retirement income. One of the most popular reasons for people visiting our YouTube channel is to get information on Canada Pension Plan benefits. So we've put together a playlist. So if you go to the show notes for this particular video, you'll see a playlist for Canada Pension Plan benefits. Just click on that. It'll give you a series of videos that you likely will find helpful as you try to understand Canada Pension Plan and how it fits into your overall retirement income planning. Again, if you just Google old age security benefits, it's a standard benefit. Go to your computer. There's lots of good information online. So get clear on those numbers as you begin to think about your retirement income planning. So let's take a look at the next area. And the next area is get clear on your retirement income plan expenses. How much will you need on an after-tax basis? And the bottom line is you're going to need more than you think. Don't use rule of thumbs like you need 70% of your pre-retirement after-tax income. What I've found and what our team's found over the years is that people's expenses don't really change that much. Because when you think about it, in the early years of retirement, you've got lots of energy, there's things you want to do, and your discretionary budget will probably increase, at least in the first few years of your retirement journey. So I'd recommend that you be very cautious about expense reductions. I'd assume whatever you are spending on an after-tax basis now, likely you'll be spending on an after-tax basis the first few years of retirement. We've just seen that from personal experience over the last number of years. Now, in saying that, we have put together some information, links to our YouTube channel on videos that we've produced in the past on cash flow planning and retirement income planning for cash flow. So again, I would encourage you to go to those videos, take a look at them. They'll give you some good guidance on getting clear on retirement expenses. One of the most important things you need to do is get clear on your discretionary expenses. Those are negotiable expenses through retirement, and get clear on your non-discretionary basic expenses. So be sure to take a look at the links to those videos to get clear on retirement expenses. It's a really, really important area. If there's one area that could really derail you in terms of your retirement income planning and your income planning security, is not being clear on how much you actually need when you hit retirement. Okay, number 3, the third topic area is understanding your employer-sponsored pension plan. So if you're fortunate and have an employer-sponsored pension plan, that's awesome. There are a couple of different types of pension plans usually organizations have in place. I'll talk about each of the plans. Now, the most important thing is lean into this topic. Don't be cavalier. Really understand how your pension plan is structured and what level of income you could expect from that pension plan, and how that income calculation is handled. Okay, those are really important factors. So you want to begin getting estimates and talking to your group benefits department through your employer to get really, really clear on how the plan works. Now, when it comes to employer-sponsored pension plans, there's normally two main kinds of plans. There's what's referred to as a defined benefit plan, or formula plan, or a defined contribution plan. And these two plans are very different in terms of how they operate. So first of all, let's look at a defined benefit pension plan. So first of all, it's a formula. Typically, it's years of service times the average of your best 5 years times a benefit rate. So a Cadillac plan would be 2% times years of service times the average of your best 5 career earnings with the organization. So what's nice about a defined benefit plan is you're not guessing about what your ultimate benefit's going to be. It's going to be driven by the formula, and those inputs are pretty stable. If you are part of a defined benefit pension plan, just make sure you're talking to your benefits department to find out whether there's any actuarial penalties if you retire earlier. So you want to be really, really clear about how that formula is handled, how they arrive at your earnings number for the formula. So just start talking to the benefits department, ask them for estimates, start making sure that you're getting clear on how the plan works. Secondly, is there a cost of living adjustment on the plan? Now, many defined benefit plans don't have cost of living adjustments. Cadillac plans do. So some Cadillac plans would be things like the like crown corporations, provincial governments, municipal governments, universities, and the federal government typically have defined benefit plans. And often those plans will be cost of living adjusted. So if inflationary increases take place in the economy, which they always do, then the pension adjustment will happen on those pension income payments, so you have a pension that stays in pace with inflation. However, you need to look at the fine print. Ask your benefits department, is there a contractual increase every year? Is there a formula for that increase? Or is it ad hoc at the discretion of how the pension plan is doing? Are there bridging benefits? So sometimes you see bridge benefits before the age of 60 or 65, where they'll give you some additional income until you get to that time when both your Canada Pension Plan or old age security benefits are paying out. So what are the bridging mechanisms if that's something that's available for you with that pension plan? And finally, with survivor benefits. So usually, if you have a partner, you'll have to assign a survivor benefit. If you die prematurely, there'll be income that will go to your survivor. And it's really important you begin thinking through that discussion before you retire. Model what the income situation will be for your partner if you die prematurely, and that will give you guidance in terms of what survivorship benefits you should attach to the pension plan. In the private sector, usually if it's a defined benefit plan, which is becoming fewer and fewer in the private sector, normally those benefits will not be cost of living adjusted, right? So once you get your income, it's going to be straight line. It won't increase over time. That's been my experience. Okay, next let's take a look at defined contribution pension plans. Now, defined contribution pension plans are completely different than defined benefit because you ultimately don't have a guarantee as to what your monthly income is going to be when you retire. So how does a pension plan work? Essentially what happens is you put money into the pension plan on a regular basis, usually each payroll period, and your employer will put a matched amount. It's very common that there'll be 5% by the employee, 5% by the employer. Once the money goes into the pension plan, you're given a range of investment options. So usually you have quite a few options you can choose from, but it's putting the responsibility on managing the retirement assets on your shoulders as opposed to a defined benefit plan where that's being done for you. Now, when you're younger, you probably want to take a more growth-oriented approach to your investments. You don't need the money right away. But as you get closer to your retirement date, you need to be much more careful about how you invest the money. Because as you get closer and closer to that end date, you should be worrying about market volatility. So it just puts a lot more responsibility on your shoulders. Ultimately, the amount of money that will be in that account will be a function of your contributions each year, the amount of performance you get on that portfolio every year. And then when you look at getting to your end point, you're going to have a bucket of money in that plan, and that plan can be used to purchase different kinds of income. That's a whole other video. So the most important thing is sit down with your employer and begin modeling how your account will change over time, what the potential growth rate is, and how you'll actually get income out of that plan when you retire. If your employer is not prepared to do that for you, then you need to make sure you sit down with an advisor who works in retirement income planning, who can begin modeling the scenario for you so you have a basic idea of what level of income you can get from that pension plan when you retire. And that model is going to be a function of various inputs. But ultimately, you need to sit down and have somebody do it for you or do your own calculations so you have a basic idea of what that income potentially will be. Very important calculation. Well, it's my hope that you're enjoying this video so far. In the show notes for this video, there's actually a link that will take you to our homepage, our webpage. On that page is information on how you can get a complimentary retirement income plan. So if you're 5 years away from retirement and you're trying to get clear, particularly on the topic I just talked about, which is how do you forecast income on a defined contribution pension plan, then go to the website, learn more about our complimentary service, and if you want to start a conversation, just click the link, reach out to us, and we can share with you how that complimentary program works. Okay, the next area you need to take a look at once you've settled on how your pension plan works is number 4, group health benefits plan retirement options. So if you have a group benefits plan to your employer, you want to begin asking questions about how will that plan change when you retire? And do you have the option to convert that plan from a group plan as an employee to a retiree? What are the costs? And then the second thing you should do is you compare that plan to what's available in the marketplace. So most large life and health insurers in Canada have private plans you can purchase. You can also go to Blue Cross. So there's a lot of options out there. Probably the most important options would be in travel health as an example. I think for a lot of people, it's probably more economical to fund your dental care just out of a self-funded account where you're saving money for that kind of cost. But the most important thing is, what is your current plan, group health plan? What conversion options do you have? And then compare those conversion options to what other companies offer. You don't have to do that right away, but as you go through the next 5 years prior to your retirement date, just make sure this is one of the to-dos that you need to take a look at. So topic area number 5 is review life insurance needs. So a lot of people think that as they get older, they probably don't have a need for life insurance anymore. And at some level, that's probably correct. Usually we have life insurance to look after dependents. If we die prematurely, we want to make sure we have a good amount of insurance to help dependents maintain lifestyle and pay for costs over a long period of time. The theory is as you get older and as you accumulate pension benefits and investments and pay down debt, your need for life insurance is greatly decreased. However, my experience has been the following. You want to make sure you look at a capital needs analysis or insurance analysis even as you've transitioned into retirement. So sometimes what you see is that as we run the numbers, there can be even a short period of time where it may be a requirement for the individual to maintain some level of insurance for the first few years of retirement. So when you run the numbers, it looks like for the first 5 years, probably need to have some insurance just in case so the surviving spouse is okay. And as you get past that 5-year period, there's no longer a need for insurance. So it's very situationally specific, but you want to just get clear, sit down with your advisor, your insurance specialist to see whether it continues to be a need. The other thing that you want to ask about is with your current coverage through work, do you have conversion options? What are the costs to convert? If you have good health, usually it doesn't make sense to convert with your employer. Usually it makes sense to get personally owned insurance privately. So it's just really just paying attention to the area and just looking ahead and saying, do we need some level of life insurance? Now, what we find with a lot of clients is that their need for personal owned insurance for dependents, if they die prematurely, is not usually an issue. But what they begin thinking about is putting insurance in place for legacy value, for estate value. So it's not for them or their partner, but for their kids or charities or other organizations. And so that's probably the most common reason that people going into their 50s and early 60s look at insurance. So permanent insurance, term of 100 coverage, universal life coverage, that kind of thing. So the most important part of this area, review your life insurance, get clear on what's going to be there when you retire. Do you need to convert some of your insurance? If not, fine. Do you look at insurance as a legacy tool? That often can be a great option for those people that have legacy aspirations. So topic area number 6 is practice retirement before retirement. I think it's a really good idea to get a sense for what the flow of your day, your week, your month might look like. And one of the ways you can do that is start using your holiday time to go to destination areas that you may want to live in when you retire, or use it for staycations where you actually mimic what your retirement day could look like. So a lot of books have been written on this topic, the whole idea of practicing retirement. I think it has great utility. I would encourage you to think about it. So if you're 5 years out from retirement, can you begin baking into some of your holidays the actual experience of just living like you retired? It's probably going to give you a lot of insights about what the retirement journey is going to be, and it's going to tie into another topic area that I'll talk about right away. So topic area number 7 is explore side hustles for income. So why would you consider this? Well, there's a lot of reasons why you might consider side hustles, and one of the biggest reasons is my experience has been a toggle switch retirement is not ideal for most people. My belief is it should be a transition over time. And I encourage people, if they have the opportunity to do some contract work, some part-time work, and not just all of a sudden be retired, that would be, I think, the ideal scenario for most people. When you think about it, there's a tremendous amount of other non-financial things that we get from work, whether it's socialization, building relationships. If we can use our skills and abilities to make a difference in the world, so we get some purpose and fulfillment from those activities, those are really, really important things to really think about in terms of our overall retirement income plan. And it ties into an area that's really non-financial. So when I work with clients, much of it is obviously on the financial applications, right? How do we coordinate incomes and investments and pensions to generate an after-tax income that you need? But there's also planning out your life. What will your life look like in the next third of your life potentially? And so exploring side hustles, I think, can make a real big difference. It has some practical financial impacts. It takes pressure off your portfolio possibly. It allows you to build more financial buffer in the early years of your retirement. But it has these sidebar benefits, which would be you're still doing some things that you get some value from, you're making a difference, you're socializing, you're still sort of connected to the broader society. And I think a lot of people, when they retire, feel a little bit isolated, a little bit lonely. So explore side hustles, and this can't happen just a month or 6 months or a year before you retire. And you want to make sure you explore these things at least 5 years before retirement. You can't do it a year before or 6 months before. Does your current employment situation allow for part-time work or contract work? Are there things that you need to begin developing on the side, so by the time you get to retirement, you've got this side hustle going for you? Okay, so it's a really important area. It's both the financial but also the personal, and building out your life plan in the next third of your life when you retire. Okay, topic area number 8 is begin to reposition investment portfolio from accumulation to deaccumulation. So a retirement portfolio does definitely look different than a pre-retirement portfolio. So before you're retired, you're adding money to your portfolio, you're investing money in your portfolio, you're letting it compound and grow. Yes, there's market volatility from time to time, but you ride through it because your point of view is you've got time on your side. But once you're within that 5-year striking distance of your retirement date, you need to begin repositioning your portfolio and thinking about your portfolio a little bit differently. So one of the big risks for retirees is drawing down on their portfolio at the same time that markets are going through turmoil or declining in value. So your portfolio now is not just about accumulation, and there still will be assets when you retire that will be hopefully growing over time. You'll have another third of your life to live. Your portfolio's life expectancy doesn't end on your retirement date. But some of your portfolio needs to be in safe harbor and repositioned in guaranteed investment certificates or term deposits, high yield savings accounts. It can't be in the market if you're going to be drawing on assets when the market is going down. So it's a really important area. Now, the way you get clear on that, again, we have in the show notes a link to our website. You can find out how you can get a complimentary retirement plan. Is either you or you have somebody walk you through a retirement income planning analysis, and that analysis will confirm for you how much money needs to be in safe harbor, how much money can be in more growth investments in your portfolio. So let me just show you a little bit of a schematic to help this to be clearer. So what you see on the screen is a timeline from 1 to 10, and it's in 3 different sections. So it's sometimes referred to as a 3-bucket strategy or a timeline strategy. But as you get close to retirement, you need to begin moving assets into capital preservation, very conservative assets. And that actually you should start thinking about it 5 years from retirement, and it might even begin within 5 years, certainly 3 years. So by the time you get to retirement, our recommendation is to have at least 2 to 3 years worth of your required income needs at the ready in safe harbor to provide income. Now, if you get to retirement and your portfolio is doing well and you're getting growth overall, you may harvest the growth for income. But if you look at markets generally, even on a balanced portfolio, every 10-year period, you're going to have 2 to 3 losing years, right? So markets are up more than they're down, but there will be those losing years. And so it's this cash portion that will help you to navigate the volatility that can happen from time to time. You then have another area, which is the income and balance portion. So that's money that might be needed in the next 4, 5, 6 years. So it's going to be hopefully delivering more growth than just cash, but it's still relatively conservative. And then you have the growth portion, which is money that's not needed to be delivered to you for, let's say, 8, 9, 10 years. And so as you stretch out the timeline, you're beginning to look at different investments in each of these timelines because they all have different purposes. So timeline investing is critical to your overall retirement plan, and it provides guidance in terms of how you should be investing money. And you need to be thinking about this cash wedge position or conservative position at least 3 years before you retire. You need to begin putting things in motion, and 5 years before you need to get clear on what do we need to have at the ready by the time you hit your retirement date. Okay, topic area number 9 is update your estate plan. So I find that, if clients have their wills up to date and their powers of attorney up to date, maybe a healthcare directive, that's awesome. What happens is people will put these documents in place, and then over the passage of time, they just don't have them updated. So when you're within 5 years of retirement, that's a great opportunity for you to take a look at your estate plan. If you have children, they're older now, so you revisit things like your executors, the beneficiaries, any trusts you have established through your will plan, and maybe your kids now are at the age of majority or older. So it's just really a good time to make sure these documents are up to date. And if you don't have powers of attorney in place for you, or if you have a partner, make sure you get them in place. We have other videos on these topics on estate planning. I'll have links in the show notes for this video, some great content we put together over the years on will and estate planning and healthcare directives. So I'd encourage you to take a look at that. But the main takeaway is, at the same time you're updating your retirement income plan, just get your estate plan updated. And if you don't have will and don't have powers of attorney, make sure you get those put in place. Okay, topic area number 10 is have a retirement income plan prepared. So some of you are really well versed in spreadsheet modeling, and so you've developed maybe some models for your retirement. My recommendation is, even if you're pretty adept at those models, I've had a lot of clients appreciate having sober second thought and someone looking over their shoulders on their assumptions and their modeling. So if you don't have that expertise, you want to make sure you work with a retirement income planner to model your retirement income plan. So let's take a look at what questions should be addressed through the retirement income plan forecasting. And these are really important areas, but they give you great peace of mind. So the first one is sustainable after-tax retirement income. So how much can you actually afford to spend on an after-tax basis? And you can customize it. You might spend more in the early years and less as you get older. Your discretionary spending may go down a little bit, but you can customize that model to see whether it's sustainable or not. What kind of investment returns do you need to aspire to? So where you want to start is, what does my retirement look like if I just use risk-free investments? I just put everything in high-yield savings and GICs. If you can't sustain your retirement lifestyle based on that, now you have to begin injecting some other kinds of investments that will give you a little more growth. You want to under-promise and over-deliver in terms of this kind of planning, but at the same time, you need to be very realistic about what kinds of returns you need to get to achieve your cash flow requirements. What required investment capital do you need? Well, that's intimately tied to your investment return assumptions and your cash flow requirements. How do you coordinate income buckets? What are those buckets? Tax-free savings accounts, RSP accounts, your pension plans through work, your Canada pension plan, your old age security benefits, and of course, if you have a partner, coordinating their investment buckets and retirement buckets and doing it in the most tax-effective way possible, which gets to the last point, which is inflation and tax resilience of your cash flow. How do you generate cash flow to protect your purchasing power and to deal with tax as best you can? So those are really important components to the retirement income plan. Now let me show you an example of what I mean by retirement income plan. I'll show you the application that we use for that kind of work. Now what you'll see on your screen is all the different spreadsheets that we use. Now this is a roll-up for a husband and wife, and so in this situation you've got all their sources of income, a roll-up with their Canada pension plan, their old age security, how their TFSA plays a role, their RSP capital, and so we get a year-by-year sense as to what the sustainable spending power is for these clients. So what you want to do is have a spreadsheet that allows you to model these things, and then we model with this spreadsheet the return assumptions and the inflation rate. Ultimately what that does, it gives us a high-level overview on how their net worth might be impacted. So in this net worth position, you can see the blue, which is their investment assets, are going down over time, and the real estate, which is the black, continues to grow over time. So going into this analysis, what they can see is that they are killing the goose that lays the golden egg, but they're not killing the goose too quickly, so that by age 95, they've gone through their portfolio, but they still have significant real estate value. So for this client, they're okay with that. They wanted to be cautious. They're okay with spending down capital they'd saved for retirement, and if they did live past age 95, they had significant real estate that they could tap into at that point for cash flow. It shows them the sustainable cash flow number that they could spend at, and then this chart shows them where the different sources of income are coming from. So the charts aren't important. The most important thing is that these models allow you to basically simulate the financial aspects of your retirement and begin making trade-off decisions about what retirement will look like for you. It's a very useful process, and one of the practical applications is how much money do you need to have in safe harbor. So this kind of analysis will give you an idea of how much we need to have at the ready to fund at least 2 or 3 years worth of income in the event that markets are not going the right direction for us when we reach the retirement date. Well, that concludes our discussion on the 10 main topic areas that you need to be clear on before you reach retirement. So it's my hope that you found this discussion helpful. It's a very preliminary review of each of the topic areas, but hopefully it'll stimulate you to do some follow-up work, do your own research to get clear on your retirement planning journey. So it's an amazing transition, full of lots of opportunity and growth, but attending to these 10 topics is an important part of the process. So again, if you're new to our channel, make sure you hit subscribe so you don't miss future content. And again, if you are in need of getting a retirement income planning forecast, you want to have somebody help you, walk beside you, and clarify these details, just reach out to us. In the show notes for the video, you'll find a link to our webpage. On the homepage, we talk about our complimentary retirement planning service. You can take a look at that, and then you can reach out to our office through the website to start a conversation. Anyway, wishing you all the best in your retirement planning and overall wealth planning journey. You take care. Bye-bye.